theory today. So I'd like to kind of put the theory to one side, and instead of looking at why certain things might happen, we'll just look at what that we're actually looking for. There are a couple of links there if you actually want to look at the webinar, some of the theoretical stuff. So we can look at things to look for and why, gauging volatility, entry confirmation, also at post-entry confirmation, which is just basically tracking trades once you're in a trade. Is it really working out for you? And the context of this is looking at JP's value-based approach to trading, which focuses on momentum, on reversals rather than momentum trading. So we're not going to look at things like breakouts and stuff like that and what to look for, because it's not really what you guys do. Okay, so to go straight in, what I'm going to talk about first is probably something that you don't think of order flow, or you might even not really be thinking about at all, is looking at the average depth. Okay, so one of the things that I do at the open is I look at my depth of market, and I've got an idea of how much depth I expect to see when the market opens. Now, if you look at different markets and you look at the way different markets move, there's a real correlation between the amount of depth and the amount of volatility on a market. So the markets with very little amount of depth, like crude oil, are the most volatile markets. It's not a coincidence. So my personal opinion is it's actually the depth that sets the volatility. So one of the things, if you just take one thing away today, you're not really interested in order flow. One of the things that's worth doing is just at the open and periodically, once every 30 minutes, for instance, look at the depth. Look at how much depth is out there. And is it above average? Is it about normal for the time of day? And what you'll find is the depth will change intraday. You can see that before a news release. But it also change when the VIX spikes. So if you look at that diagram there, we've had 3 times this year when the VIX spiked to over 21. And each time it did that, about 60% of the liquidity, or 60% of the depth, was pulled out of the dome. So basically, I don't know if that's HFTs or stat arb players or market makers, whatever they are. When the VIX gets to a certain level, all the depth disappears, and you can go look and have a look at the VIX, and then have a look at the intraday charts of those periods, and you will notice there's a huge correlation between looking at the depth, and looking at the volatility. And what you'll find is the VIX will usually spike, and then it will be the following day that you see the volatility change. Now, obviously, there's another factor here. Let me just bring up the depth. Okay, where are my screens? Okay, let's try that again. Okay, so what I'm going to show you, this is my market depth. Now, what I can see here, if we just look at the ES, can you guys see my cursor? Okay, good. What you see here right now, it's before the open. This kind of depth that you see here, 157 on the offer, 700s the next level up, 800 the next level up, that's pretty low. What you'll find is when the VIX spikes, those are roughly about the same numbers that you're going to see when the market opens. So if you see the market open and you see 600-700 contracts on the depth, and that stays that way, once you get 5-10 minutes into the open, you've got to expect that it's going to be a volatile day. You're going to need wider stops, and you're going to need, bigger targets as well. You're going to have a lot more movement. Now, obviously, there's another factor there. Obviously, if we look at today, let's just bring one more thing across, which is the volume. So this pink chart that's got minus 58,000, that's actually showing us relative volume, which means for the time of day right now we're about 58,000 contracts below average. So obviously with the depth being lower, you will expect to be more volatile, but obviously if there's less people actually trading, it will all kind of even out. So really the first thing to consider when you start looking at the depth, when you start looking at order flow on any one day, keep your eye on the dome. Just check if it gets really thick. If you see every level there, 2,000 or 3,000 at every level, the market's not going to move. It's going to be in a tight range. You're not going to see any movement. The only thing you're really going to be able to do, is kind of scalp the range. Okay, so that's the first use of order flow in trading, and that's something I do every day. Not all the time. It's every 30 minutes or so. At this point, does everybody know what the columns are in here? Somebody asked me if I could just explain the columns on this screen. Do you want me to go through that now? Okay, that's okay. So I'm going to go quickly look at this ES depth. We've got a lot of columns on here. You don't need to use all of the columns. You can switch some of them off. Certainly, you don't need to use all of the columns all of the time. Okay, so the columns that you would focus on the most, because the most important thing you need to look at with order flow is actually the flow of orders, which is probably why they call it order flow. The market depth is really secondary in terms of what you keep your eye on all the time. So the columns here that are kind of in the center, they're kind of a little bit offset. We've got a red on grey and a blue on grey column, and that is just showing me the trades that are hitting in to the bid and the offer. So right now at 1804, we've got a 131 in red, and that means 131 sell market orders have been sold into the bid at 1804. And then across and above that, we can see 739 right now, and that was the number of buy market orders that are traded into 1804.25, and we can actually see that 141 sell market orders went to 1804, 760 buy market orders went into 1804.25. Not a really big surprise that we ticked up from there, because there's more buyers than sellers, or rather more market buyers than sellers. So those center columns are something we call current trades. Now, we saw when it ticked down there, that 760 trades disappeared. Okay, now the reason they disappeared is because those center two columns tell you how many people trade, or how many orders traded, contracts traded at that level this time round. So if you tick up out of that level and then come back into a level, it will actually clear, because it's not this time round, it's a new time round. But what it also does is, if you only tick up for a small amount of time, so if you just tick up for half a second and tick back down, it won't clear the numbers. Now, you can adjust that kind of period that it sets, how long outside of a price should I stay before I clear it when I come back. I wouldn't recommend you do that, because the default settings are about right. So that's current trades. Now, if we move out, the column just to the right of the price is virtually the same thing. It's actually showing me the trades that have hit into the bid, but it doesn't clear. So it's almost like the numbers you'd see on a footprint chart almost, except it's not a chart. So that's the total number of orders that have traded into the bid, total number of sell market orders at that level. And then over on the right hand side, the far right, is the total number of buy market orders that have sold into the offer. So basically, the numbers in the middle are showing you what's trading this time round, and then you go outside to those other numbers, and that's kind of giving you a longer term view of what's traded overall. Kind of debatable whether you really need those numbers, or whether the volume profile itself is good enough. I tend to watch the volume profile, which is the third column, where we've got the third column, which is numbers, and a kind of a bluish turquoisey green background. What we can see there, that's just showing us total trades that have hit into each price since the open. I've got this set, so that's going to clear down when the market opens. For me, I find that just volume at price is actually as good as looking at how much trade is on each side, because at the end of the day, every trade is a buy and a sell. You know, the market's just matching buyers and sellers. So I kind of figure if a bunch of people got in at a point, I can presume that half of them were buyers and half of them were sellers. And to me, that's good enough information. Now, one of the things about these columns here, we can actually clear these columns here. So right now, I'm kind of coming up into this, the high of the day. What I could, if I wanted to, I could actually say, right, I'm going to actually clear those columns above as I get into the high of the day, so I can now reset and see what's trading this time round. Okay, so in terms of the trade numbers, that's all there is for the number of contracts. So we've got a volume profile, a split volume profile showing total at bid and ask, and then what's trading right now. Okay, so that's kind of the order side. Then the blue column I've got here, I've got two columns in blue. One is obviously, or I think obviously, is the bids. And then to the side of that is the adjustment in the bids. Okay, so what's changed in the bids? So basically what we're looking at, we've got an inside bid there about 450 and minus 155 to the side. So what that's telling us is I've actually got bids for 450, but since we got to this level, they've actually pulled 155 bids. Now on the other side, on the red column there, I got, is it going to settle down? Okay, I've got offers of 176, roughly 170, and they're actually adding. So I've got a positive number there, which means since I got to this level, they've added 270 contracts. Okay, so what you get from here right now, we can see the bids are pulling and they're adding to the offers, but the offers are getting pretty low. The offers just dipped below 100 there. So that's kind of when they stack the offers like this, as you see, our market's just opened. When they stack the offers like that, the chances are it's going to go down because they keep refreshing the offers. Okay, so basically we've got the blue and red columns, which are bids and offers, and outside that it's the adjustment to the bids and offers since we got to this level. If we tick up or tick down, that adjustment number will reset. Okay, so the moment I tick up, it's all of those numbers start at 0. As you can see, started at 0, and then you can see what people are doing. So okay, when I tick into this area, what did people do there? I can see on the offer now 1,000 contracts have been added. I've got 1,300 traded, 1,000 added, and they tick down. Okay, so that's kind of stuff that we're going to see later. You probably focus on more when you are trying to get your entry, or you're going to focus on that. If you're like, right, I think I can see the order flow is on my side. I'm in a place that I want to hit into. Now I want to enter the market, and that's really when you're going to look at those numbers. Okay, so that's the red and the blue column. This column here, okay, that's just a place that you can put in your levels, and the levels I've got, obviously I've got yesterday's high, opening price, value area high, value area low, and yesterday's low. So I just mark off those levels on the dome before the market opens, and then I'm kind of not so interested in looking at the charts or anything else. I just kind of focus on watching these screens. So for people, just go. The second column just shows me where my orders are. Okay, so I've got a 5 lot limit order at that level. Okay, and if I get filled, it actually shows me also my fill in that column. So those are the columns. If you are starting out right now, having never used a tool like this, you would actually focus on the center 2 columns. Excuse me, I should get a drink. Wow, I peaked too soon, I think. Okay, so the center 2 columns are the most important thing, because the most important thing is which side are people trading. Now, if we just go quickly and look at the right-hand side, this is what we call a power meter, and this power meter is showing me pretty much the same information in these columns here. So if I reset that, and in fact if I just reset everything, what I can actually see is this first meter on the left hand side is actually showing me the total trades that have hit into the bid and the total trades that have hit into the offer. So we can see right now this is mostly red, which I've got more sell market orders since I reset this. So more orders have traded into the bid than the offer. Now the center one, the center meter, is basically showing me the depth. Now what I've got this set to over here is I've got it set to depth power meters, 3 levels. So I've got it set to 2. I'm going to change it to 3. What it's actually showing me, this is showing me the sum of the first 3 levels of bids against the first 3 levels of offers. You wouldn't want this middle meter to show you all 10 levels, because it's kind of, you're really interested in what's happening near the market. You're not really interested in this 1800 lot offer up here. So this is showing you the bids against the offers. I've actually been using this just set to 2, just to look at the 2 inside bids and offers. Although to be honest, I usually turn this centimeter off, because really I'm interested in the trades, and when I get in, I'm interested in the right hand strength meter. Now the right hand strength meter is showing me the pulling and stacking activity. So it's this outer red and outer blue column here that are showing me, are they pulling orders or are they adding orders? So the way it works is, because you're going to watch this on video and say, oh man, that doesn't add up. It's, you know, smoking crack when he wrote that. What is happening is the blue side is showing me the contracts that are added to the bid or taken away from the offer. So if you have 100 contracts added to the bid and 200 contracts pulled from the offer, then it's going to show 300. And again, if we just look at these settings, I've actually got that set to the first 5 levels. I mean, that's probably a bit too much actually. Maybe set it to the first 3 levels. Okay, so what you're actually seeing is you're actually seeing which side are pulling and which side are adding. So the way it works is it considers pulling an offer to be bullish, and it considers adding to the bid to be bullish. And what you'll find is, as the market moves up or as the market moves down, when it ticks down, the meter's going to kind of go more central, and then it should go red. And it'll tick down, then it'll go central, and then it'll go red. Tick down, central, it'll go red. And then when it goes all blue, like it is now, then it's a sign that actually it's going to tick up. Okay, as you saw, it ticked up then. So that's kind of a cool little tool. It actually does work quite well. But it isn't something you'd want to watch every tick. Okay, so that's a description of the columns. Does that make sense? Okay, it made sense to one person, and that's good enough for me. Just to talk about the strength meter on the right here. This strength meter on the right is actually tied to this time in sales. So this time in sales, or this reconstructed tape, is just showing me the large trades, 100 contracts or above. So this strength meter on the right is actually just showing me the ratio of large trades on the buy and the sell side. Okay, so average depth is what we're looking at. What we're going to do is go a little bit slightly theoretical and look at something we talked about before, which was reversals. And all reversals we talked about before contain one or more of the elements below. And in terms of being able to see these on the dome or on the tape, they go from easy to hard, from 1 to 3. Now, every reversal, the market can't reverse unless one or more of these things happen. Now, it's okay to spot these before or after you enter. So don't look at everything we're going to talk about today as stuff you have to do to get into the market. If you want to put a limit order resting at a price, then put a limit order there. So if you want to go short, if you've got a price above, you want to go short, put your limit order in there. But you want to be able to see these things happen after you get in if you trade that way. Okay? So these are the things that confirm your trade before or after. And basically absorption is the first, which basically if your market comes down, everything we'll talk about now today, we're going to talk about short to long, actually, I should have said, not long to short. Or am I talking about short to long? Okay, yeah. So short to long. So market's going down and it's going to turn up. Okay. So absorption means the market moves down, people still keep selling, but the market stops moving down, which means the bidders are actually staying firm. The bidders are saying, okay, you guys sell to me, you guys sell to me, you guys sell to me, I'll take all you've got. Okay, that's absorption, that's all it is. No need to go into too much more detail. Sellers fading away, fairly simple. You get to a price, sellers stop selling into that price. Okay, it's not very difficult to spot, to be honest. It just can happen quickly, and it can happen very often. Okay, so you'll see the market pause all the time. So if you take this out of context, away from an area that you're actually looking to get into a trade, you're probably going to get stopped out a lot. Okay, so the other thing that's going to happen for reversal is buyers will come in and start buying. Okay, so buyers will actually overpower the sellers. Now that could happen after the absorption. It could happen after the sellers fade away. It could happen after absorption followed by sellers fading away, or it could just happen on its own. I know this is what JP calls the roll. Okay, so if it just happens on its own, it's going to be pretty hard to spot in terms of looking at that to get an entry, because you could be waiting there. Okay, it's coming to my price. Boom, buyers come in and it moves up 6 ticks. Okay, so that's why we say, you know, 1 to 3, easy to hard in terms of identifying on the order flow. Okay, so we won't talk too much about that because it's slightly theoretical. But what I do want to talk about, because this is something to bear in mind as you are listening to me today. Okay, we've all entered trades and seen them go offside immediately, and then come back to your entry price and just like tickle around at your entry price, giving you a chance to get out before it then takes a dive. Okay, and that's not something that happens on all markets. So if you look at a market like the US Treasuries, US Treasuries take a long time to turn around, and it's a bit like moving one of those, you know, big container ships, right? You know, once it moves around, it's not going to wiggle its way back. So one of the things about the ES, the ES has got a tendency to give you second chances, okay? And that's second chances to get in, and definitely second chances to get out, because I'm sure everybody has entered a trade at the worst price, seen it come back, just offering you up a chance to get out, not taking it, and then it's just taking a dive on you. Okay? So one of the things about order flow and the ES, being right about the order flow doesn't necessarily mean you're trying to hit into a level at your first suspicion that a turn is occurring, right? So you can, if you see the absorption, you don't have to hit into that straight away, because it's not the kind of market that's just going to shoot off 10 ticks without, you know, coming back and giving you a second chance. And also, being wrong does not necessarily mean getting out at a loss. Okay, there are certain things you're going to see on the order flow. So if you do something like that, you get in at a price and it just moves against you, and then it comes back to you. There's certain things you can look at in the order flow that when it comes back to you, you say, actually, this really looks weak. And, you know, I might just take a 1 or 2 or 3 tick loss on this trade instead of holding on a bit longer. Okay, so just keep in mind that we're talking about a market that does give you second chances, and that does affect the way that I use these tools. Okay, so the first one, we're going to look at the dome perspective, and then we're going to look at the tape perspective. Okay, so the absorption on the dome, okay, is just a large quantity of volume trading at or near your level. And by large quantity, you're going to see on your dome, you're going to see how much is trading into each level for that day. Okay, so if you've got a couple of thousand trading into that level, you really want to see 5,000 or 6,000 contracts trading around your level. Okay, it won't, obviously it won't be to the tick. I mean, it often is with the ES, You know, it won't always be to tick. Sometimes you'll see a lot of volume trade, and then it will move through that price. But as it moves through, the volume drops drastically. Okay, so sometimes you'll see the absorption. You can hit into the absorption straight away, but sometimes it's good to let it play out a little bit. So basically, market will often move through after the absorption, and also it will often move through your level, come back, and then you'll see the absorption occur when it comes back. Okay, now the other thing is the market is often going to pull back to the level where the absorption occurred. Now that kind of might be a bit of an odd thing to say. Why would it come back there? Well, maybe another way to look at it is if you have that absorption near the low, okay, and you do actually reverse. So you're looking at short to long. You have the absorption near the low. It moves up 3 or 4 ticks. When it comes back, that area where you had that absorption will be the thing that stops you getting a double bottom. Okay, the reason that it won't actually go down to the lows again to retest the lows is because of the amount of volume that trades is at that level. Okay, so I'm gonna say we don't need to go into the theory of why too much, but that will actually stop the market. Okay, so in terms of what's aggressive, well, an aggressive trade is that when you see the absorption, then you hit into it. Okay, so the moment you see that 5,000 or 6,000 contracts, you hit into it. I would say if you're going to do that, you really want to be scaling out some 3 or 4 ticks, because quite often you'll get that absorption, you will get an initial reaction, and then it will move straight down. Okay, and all you're doing basically is you're taking a more aggressive trade. You're getting in just because you see that amount of contracts trade. You're not watching the next part of the story. You're not letting it play out a little bit more to see, you know, okay, is it really showing another sign it's going to hold? You're getting in at the first sign. So if the market prints volume, you know, in terms of less aggressive, if you get the absorption printing the volume, then it pops down to 2 to 4 ticks, and you see that, you know, I might print the 6,000, then 3,000, 2,300. That's a much stronger sign, and actually a place you can get in at a better price, because as you see the sellers kind of fade away as you go down 2 to 4 ticks, you've got some kind of added fuel to your fire. Now, if the market prints the volume and pushes straight up from there, okay, you may well have missed the trade, but you know, you wait for it to actually come back to that level and retest it. And the other thing you're going to see is what will very often happen is when you get these reversals, obviously if you print volume, it'll come back to the area. It shouldn't be able to get through it. Now what will happen quite often is you'll go to a low, you'll get the absorption, you'll go up 4 or 5 ticks, you'll get another level where you trade 3,000 or 4,000 contracts, 5,000 contracts, right? If that happens, it's not going to come down to the original absorption point. It's not going to come down to the original reversal point. What you've got to look at is the potential that it's actually going to come back down to that second area of high volume and not get passed through there. Okay, and we're going to look at the dome in a second, but we will just look at the tape, the things that we're going to look at on the tape as well before we look at the dome for absorption. Okay, so in terms of the tape can mean a number of things. Traditionally, tape means time and sales, which for Jigsaw would be the reconstructed tape. The tape could also mean that current trade column in the middle of the depth and sales, the one I said that, you know, if you're just starting, that should be your focus, because that is showing the time and sales information. And the tape could also be the leftmost strength meter or power meter that's showing you the actual sell orders against buy orders. It doesn't really matter which one you're looking at because they're showing the same information. Okay, so one of the problems with absorption, and the reason if you fade every absorption, is because there's a lot of correlated markets with the ES and there's a lot of arbitrage going on. So quite often when you see absorption, you could be looking at one half of a stat arb trade, which is just somebody, you know, maybe they're selling the futures and buying a basket of stocks. And if they're doing that, they really don't care about which direction the market goes in after they get in. So there's no concept of them being trapped. Okay, so their trades, that trading that they've done there, doesn't really have any directional impact after after they did get into the trade. Obviously, they are going to unwind the trade, but they might unwind it below or above, and they might buy, unwind below, and still be making a profit because it's an arbitrage trade. Okay, if you see the absorption at the low, you want to let the sellers burn themselves out. So if you see 5,000 or 6,000 contracts trading, but the sellers are hitting it, and it's really rapid trading, there's no reason to buy into that. You really want to see those sellers burn themselves out. And one of the reasons is a lot of other people are waiting for those sellers to burn themselves out, and it's like wolves smelling blood. As soon as they smell blood, as soon as they think the sellers have burnt themselves out, there's other guys that will buy into that, knowing that those sellers are actually trapped at that low. Okay, so you need to let them burn themselves out a little bit, because if you don't wait for them to burn themselves out and they keep hitting it, they will go through the level. So even though a bidder steps up 5,000 or 6,000 contracts, absorbs 5,000 or 6,000 contracts, there's two possibilities. One, he could be a stat arb trade. Two, he could be getting his pants pulled down. He could be a losing trader. Just because somebody absorbs 6,000 contracts does not mean he's going to be successful. So you wait for the sellers to fade away, because if they keep selling, they will burn through. Okay. And the other thing you don't want to see large sell market orders trading into it. Okay, so when you see the absorption, it's really not good to see like 1,200, 900 lot orders sell into that low if you're about to buy it. Now the exception there is that those large orders, when you see the 1,000 lot orders go in, they quite often get stuck. Okay, so when you see the 1,000 lot trade hit in, and then you see that the market can't tick down, okay, that's a really positive thing to see somebody throw 1,000 sell market order in and price ticks down one tick and then ticks back up, because it means that guy's trapped, right? Now he could be an arb trader as well, but you have to try and build a bigger picture. You can't, you got to try and put faith in something, so to speak. So basically, if you see absorption and you see some large orders coming in, again, it's a sign that says, give it a little bit of time. Give those guys time to sweat a bit. So if you see like 1,000 lot order, a 900 lot order, an 800 lot order sell in, give them a minute. And if it still doesn't tick down after a minute, those guys are going to be sweating, right? Because every trade, at the end of the day, every trade's a buy and a sell. Okay. And one of the reasons I use the volume profile more than the split volume profile or a footprint chart is because every trade's a buy and a sell. And the thing about the absorption is one side is going to be trapped. Whether it goes, if the market's trading down and somebody buys 6,000 contracts, right? The 6,000 contracts sold, 6,000 contracts bought, either the sellers or the buyers are going to be trapped, right? One or the other, okay? So you're just trying to marry that in with a good trade location. You're trying to say, well, we're at the value area low. One side's going to be trapped here. That's going to give me fuel to the fire if it goes up, because I know other people are watching the value area low. And that's the whole point of looking at the absorption. One side will get trapped. And one side getting trapped is also the reason that when the absorption level gets revisited, that it won't go through the level. Okay. Now let me just go and pull up the screens again. Okay, where are we? Okay, so we don't really have a good area. Okay, so you've got the screen. You should have the screens up there now. We've got kind of a thin market here. Let me just clear that down there. We don't really have any chunks built on the volume profile yet. We did see a lot of trading around the open, but this is obviously showing us the way down and the way up. We've got, if we look up, really, there's no area of thick volume. You could probably say like 804 is the first area. Okay, we might actually look also at this 805.50 where we got 5,300 traded. We would have looked at 806.25, but we've just started to fill in the area above. What we did see when we came here, we had these two prices here, 806, 806.225, 807, 806.75, where we had slightly higher volume, but again, nothing really significant. One of the things is about, if we look at this 5373, okay, not a huge number, but that means 5,373 people or contracts were bought and sold at that level. Okay, and this is why I'm going to explain why I look at the volume profile more than anything else. Okay, so 5,373 people or contracts were traded there, buys and sells. Okay, now as we moved up from 805.50 to 807.50, we can presume that some of the people that traded at that price might have been entering long-term positions, and if they were entering long-term positions, we can effectively forget about those people. We can say that some of those people were stat arb traders with no directional bias afterwards, in which case we don't care about those people. Some of them will have been short-term traders. So at 05.50 we're going to have a bunch of traders, short-term longs and short-term shorts. Okay, now when I go from 805.50 to 807.50, okay, how many of the shorts are still going to be in the market when we get up to 807.50? Anyone want to hazard a guess? Not much. I think that's a very good answer. It's so yeah. It's basically, we all know if you went short at 1805.50, by the time it gets up to 1807.50, not many of those shorts are going to be left. A lot of them will have get shaken out. Some of those shorts there will have stayed in, and then will have sweated up to 1807.50. Okay. Now, if you were a short, okay, at 1805.50, and the market went up 2 points and then came back to your entry point, okay,
Walk by.
What would you do? Okay, would you stay in the market still after sweating through a 2 point move against? It probably is the correct thing to do, but a lot of traders, when it comes back to 1805.50, a lot of the people who went short there will see that as an opportunity to exit the market. Okay, so what you have then is the 5373 buys and sells. We go to 1807.50. Some of them get shaken out. Okay, on the way up. We come back to 1805.50, and some more get shaken out, and they get shaken out by buying at that point or just ahead of that point. Okay. In the meantime, how are the buyers feeling? Okay, if you bought 550, you might have already scaled some out by the time you get to 750. Okay, so if you bought at 550 and it comes back to 550, you might have already booked some profits. You'd be pretty happy. You're not really, some people will sell at that point, but when you get to 550, you have a situation where the sellers aren't going to sell again. Okay, and some of the sellers are going to buy, but the buyers really don't have any reason to sell. In fact, some of the buyers might put some more on. So that's why we say when it comes back to an area of high volume, or relative high volume, we don't have a high volume area. 550 is really not high volume. But when it comes back to an area of high volume, it tends to stop at that point. It tends to not go through it just because of that dynamic of, at this point, from the people who got in at that place, which was a significant amount, how many of them are actually going to stay in, or how many of them are going to buy when we come back? And that's really the kind of frame of mind in terms of using this volume profile in conjunction with some of the things you see on the time and sales and the DOM. Okay, so let's go to the next one. At this point, do we have any questions? Okay, Lasco, I'm just reading your post. Okay, so in terms of every buyer as a seller, the marketplace itself, all it does is matches up people who want to buy and people who want to sell. So when I see the 5,000, we've got 5,500 there, some will be sell market orders, some will be buy market orders, some will be sell limit some will be sell limit orders, and some will be buy limit orders. But if you balance out the market and limit orders, it's an equal amount of buying and selling. Okay, in terms of market orders, I absolutely agree. In terms of market orders, it is not equal. But in terms of overall, who traded there, it is an equal number. Okay, any other questions or comments? Okay, so let's just watch as we get into this level. One of the things, we're going to look at the seller's fade in a minute, but I'm just going to hang around here just in case the sellers actually fade. So let's just, okay. So what we had an area, this 550, it was kind of relatively higher volume, but to be honest, 5,000 contracts isn't very big. And what we've done now, we traded the area above, so we've actually got higher numbers above. At this 550 now, we've potentially got this thing about the sellers fading where, we're getting down to this price. So far we can see 2,500 contracts traded into 575. So far only 389 contracts have traded into 550, plus it's a step on the volume profile. Okay, so that is kind of a buyer fade in action. Now what we need is we actually need that followed up now. We've got a couple of ticks out of it. We need that followed up with some large guys. I mean, if I can reset this, some large trades coming in on the buy side. We can already see, since I reset that, the buy market orders overpowering the sell market orders by about 3 times. We've only ticked up 2 ticks, yeah. So it's early days. So this is a typical kind of thing that you're looking for. We see the seller fade. Now we're waiting for the buyers to step in. Now, if the buyers don't step in, then the other side's going to smell blood and try and push us down to that level. So now let's see, are they going to sell into this level? 550. Are they going to sell 2, 3? We need some big contracts to come in now. Because if some big contracts, sell market orders, don't come in now, the buyers are going to become kind of emboldened by the fact that nobody's selling into that level. Okay, so we've got 130 contracts there at 575. Okay, if we look now on the strength meter on the left, we had the buys outnumbering the sells by 3 times earlier on. It's now less than 2 times bigger. So the sellers are coming in a little bit. If you look at the bids, the middle strength meter just slightly on the buyer side. The stacking is on the buyer side as well. Okay, we just need somebody to pile in. I mean, we are in the middle of a kind of a choppy day anyway, so it's not a good day for action. But let's just give it a minute or so, and just see if we can see somebody step in. To be honest, if I was trading for a continuation trade, I would have probably got in already. I would have probably taken that long. Now that probably is the kiss of death and making it go down, but that is where I would have got in because of the lack of trading, where we got this high volume at 550, and we've been down there a few times now. Only 419 contracts traded against 3,600 at the price above, but so far the buyers haven't picked up on it. The buyers really on a normal day, the buyers would have picked up on that already. We got 1 contract traded at the level below. Okay, sellers coming in. Okay, come on. So we've got 414 lot buy order there, 575. That's a guy who probably won't be very happy if the market doesn't actually tick up to 6. Okay, well, let's not spend too much watching this because it is a slow day. But we can see basically when we come back to this, just make a note that we've got this 1805.25 level where nothing traded. We tick down and nothing traded. We'll see what happened afterwards when we come back to it in a couple of slides time. Okay, 7.750. We 2-tick the old high, and we got a roll. So I'd be looking to set a retrace up. Well, basically what we just talked about is look at where the clumps are, or the high volume nodes in the volume profile, and what we just saw where we had a price that nobody wanted to touch. We went to 550 a number of times, and just people weren't trading into it. Okay, so let's just so Murphy's right. It does allow you to see whether offers are being added to, but it also shows you clearly how many people are actually trading into a level. So if you want to buy 550, you don't want to see aggressive selling coming into your level, okay, which is more traditional tape reading. Okay, let's just let me just try and hide the screens. Okay, now seller fade, which is what we just looked at, to some extent requires you to be a bit faster on the button, because absorption usually takes 2 or 3 minutes. Okay, and what we can see here in this image is a typical case of the sellers fading away. And what we can see there, if we look at 1802, we can see that we've got 6,000 contracts traded at 1802. If we look down at 1801, we can see the total number of contracts traded at 1801 is 251 contracts. Okay, we can also see that the red number, there's a 30 red number in the middle, and that's the current trades, and that means that if there's a 30 there, that's the amount that printed last time round. So what you can tell just looking at that one screen is that we printed 1801 a number of we printed 251 contracts at 1801 on the last time, and we went there multiple times because on the last time there we saw 30 trade. Okay, you can also see that the fade is gradual. Okay, so this is on a little more volatile market. We can see that we had the 6053, below that 3311, 1477, 1252, then 251 contracts. So you see kind of a gradual fade in the actual trading if you look at the profiles, very similar to what you see on the footprint chart. Okay, and what you need to do with the sellers fading out is most of the time it's going to hit multiple times. I mean, there are times where it comes into a price and it just hits once. So there's times where it fades gradually, and sometimes you'll see 7,000 contracts trades and it will tick down and it will print 5 contracts and then boom, it'll be off. And that's kind of a tough one to trade. A lot of the time what you'll see is it'll be a bit more gradual, and it will keep coming back. It will keep going back to that price and trading a little bit. And what it will very often do, it'll come back to the price, tick up 2 ticks, come back down to the price, not print many contracts, tick up 3 ticks, come back down to the price, tick up 2 ticks, come back down, tick up 4 ticks, and you'll see it start to lift a little bit higher each time. Okay, so you've got to kind of balance out between just seeing it go into a price once and printing like 20 or 30 contracts. That is something that the market does all the time, and you've got to kind of balance that. But now you're going to be looking at a specific level that you've already predefined, like a value low or yesterday's low or something like that. That gives you an extra fuel, but it's always better to let that occur again. Okay, so they didn't hit it. Okay, so let it come down and see them not hit it again, and let it come down and see them not hit it again. If it does that multiple times, for me, that's enough confirmation. Okay, and of course, you're going to be wrong sometimes, and you're going to be right sometimes. So, if you're looking at sellers fading on the tape, okay, so we talked about the tape. That could be the strength meters. It could be the time and sales. It could be those columns, the current trade columns. Okay, it should be fairly obvious whichever tape you're using. So the tough part about watching the sellers fade away is often it happens kind of quickly before you have a chance to do anything about it. You can very obvious, but it will always be obvious. Okay, it will always be obvious that you just get to a price no one wants to trade. Now you might have some very large sell orders at the price above. So it might be 1801, nobody wants to trade, but 1875, you saw a 750 lot and a 1,000 lot contract order, sell market order trade into that level. And that is something that is kind of a wonderful thing to see, because you see that there's this will to sell the one price, but there's nobody there at the price below. So it's a good thing to see, and you want to see it come down to your price a few times when you see those large trades. But you know that those large traders that traded the price above are seeing exactly what you're seeing. So if you put a 1200 contract sell market order in, you see it tick down, print 30 contracts, tick back up to your price, you're not going to be happy to be seeing that. And then it ticks down again, okay? If it ticks down again and you see like another 30 or 40 contracts trade, why isn't the guy that put the 1200 lot sell order hitting into the price below? Okay? Probably because he's somewhat nervous about the fact that nobody else is there. Okay? So seeing large orders, the tick above, is actually a good thing to do when you see no sellers go into like the price below that. You don't really know if it's a momentary pause or a general reversal until you see the size or the momentum coming on the other side. Okay? Now remember, we're talking about a market that does give you second chances. So if you miss the actual reversal itself, it doesn't mean you're never going to be able to get onto the long trade. Okay? Now the longer the level doesn't get hit, the better. There's like a sweet spot, like 3 or 4 minutes. If you keep coming down to a level and nobody hits into it, and that carries on 3 or 4 minutes, it's like the buyers smell blood. And what you'll see, you get there 3 or 4 minutes and you can just kind of almost feel the anticipation, and then buyers sell into it. So if you see a price not getting hit and that kind of lasts for 30 seconds, then yeah, if it goes down, it's 30 seconds and it goes down a few times and nobody hits into the price, yeah, that's pretty good. But when it lasts 3 or 4 minutes, probably an exception on a day like today where it's going to be really, really slow anyway. But on a regular day, you see that 3 or 4 minutes that nobody hits into a price, you really should, you really can buy into that. And you don't have to take a great deal of risk buying into that if that is the level that you're leaning on. Okay, so if for me, somebody who trades like me, if I'm leaning on a level like that, then I don't really need to let it go a lot further past that level to know that I'm actually wrong. Now, one of the things to be aware of, if there's a lot of volume above you and you're hitting to price, hitting to price nobody's hitting into, we could actually be starting to slow down and we're starting to move into a trading range. Okay, but that probably doesn't concern you guys too much, but basically if it goes back up through the volume and then comes back down again, you have to be a bit cautious. So those high volume nodes that are built, if we move down, build a high volume node and we kind of move through it from above and below, that's more a kind of sign that we're actually going to start to move into a trading range. So just be a bit careful if it moves up as expected, but then it can't seem to escape the high volume that's built above us. Okay. So let's just go back and see how did our sellers do. Okay. So again, what we haven't seen, okay, we actually did see originally that 550 was the price, where we had the high volume. What we saw from that point, we can see 7,000, 2629. We actually did print it into 805.25, 943 contracts. We could see that at that point sellers weren't selling into it for quite a while. Right now, we've just gone up to 1806.75. It's a slow day. Probably what's happening now is from 550 to 07. We're probably going to start to build a trading range around that area. But are there any questions on seeing the sellers fade away? Okay, I will presume there are no questions on seeing sellers fade away. It's not actually a very difficult thing to see. I mean, it's literally saying, I'm at this price, nobody wants to sell there. And if you combine that with some people trapped above, that's a fairly good reason to get into a trade. Okay, so let's just take that down. Okay, buyers jumping in. Okay, so one of the first things about buyers jumping in, it's very easy to see. Okay, so if it comes down to a price that you're looking at and without any warning buyers jump in, it's a very, very easy thing to see. It's just a difficult thing to see and actually use as an entry signal. Okay, because at the end of the day, if buyers jump in, it should push the price up. Okay, so if the market's going down and it comes into your value area low, buyers jump in. If that signal is valid, the price is going to be 3 or 4 ticks higher by the time you see it, or by the time you register it. Now, if buyers jump in and it doesn't move up 3 to 4 ticks, then those buyers are trapped. So that's actually not something you want to see if you want to get into long trade. So when we say buyers jumping in, we really mean buyers jumping in at your level and price moving up on the back of that buying. Okay, so it's a difficult thing to see, but often you're going to see the absorption first, and you're going to see the sellers fade away first. Okay, and also bear in mind you may just be using the dome to stay in a trade. So once you've actually got in a trade and you see the buyers jump in, you can kind of be a little bit more relaxed about staying in the trade. Now, when the buyers jump in, what you're going to see is you're going to generally see a little bit of volume build on the profile. Quite often the sellers will actually pull out of the way first, but generally when you see the buyers jump in like that, you'll actually see a point at which the volume profile or your footprint builds some volume on the way up. Okay, and if that happens, just for the reasons we've already said, if that happens, you're probably not going to get another second chance at your level. Okay, so if the buyers jump in and you miss that, you're a bit slow, you didn't see them jump in. If they build volume after jumping in at a level, then that level is probably going to act as a backstop and will probably be the thing that stops you getting a double bottom. Okay, so one of the things about seeing buyers jumping in and missing a trade is the worst way to play it is jumping in when the buyers have moved it up 8 ticks because you think you've missed it. Okay, if you've missed the turn, you have to look backwards and say, okay, did the market build a backstop on the way up? And that backstop should be something you see on one of the profiles, whether it's the split volume profile, the footprint, or just the straight volume profile. Okay, buyers jumping in. Okay, one of the things that we're going to look at in a second is clearing the tape. Okay, so we'll look at that in a second. But what you want to see when the buyers jump in, you want to see the overall action being fairly one-sided. So if you just got into a long trade and the buying is between 1.5 to 2 times or above the selling in terms of market orders, that's a very good trade confirmation. Okay, if you see buyers jump in but it's about even, you're really not getting any edge off the tape. You're really not seeing any edge in the trade from the tape at that point inside. Now, so as well as the overall ratio of buy market orders, sell market orders, seeing large trades on your side is a definite plus. But again, when you see large trades, you've got to look at a large trade in the context of the move it actually generates. The moment you see large trades not getting any traction, not being able to move the market up, that starts to turn into a minus. Okay. The other thing is the size of the move that those buyers generate, and the pace is also important. So if the market moves up 6, 8, 12 ticks fairly quickly off the low with fairly rapid buying on the tape, happens in a fairly short amount of time, again, that's obviously a very good trade confirmation, because what you're seeing is actually people thinking they missed out, jumping on that trade, and because there's a lot of other people on the side of the trade. So for me, the speed of it is important. I know some people would say that's actually a negative thing. And then on the other side, buyers jump in, the market's not going to go up forever. So when the market actually retraces against you, you don't want to see large sellers coming on the opposite side unless they're also getting trapped. Okay, so you don't want to see them coming in quickly. Now, quickly is very subjective. So like, if you watch the tape for a while, you begin to see the pace of the tape. And there are some indicators, free indicators out there as well, that show you the pace of the tape. You expect the pace on the way back to be a little bit slower, and you also don't expect the ratios to adjust too much when it pulls back. Okay. And the other thing, if there's no backstop built, if we don't get a chunk of volume on the volume profile, and we do come back to the level, if you saw buyers jump in at that level and you go back to the level again, you absolutely should expect those large buyers to jump in again. So if it just goes to the low and labors at the low, that's probably the market giving you a second chance to get out. Now, let me just show you what I was talking about when I said, excuse me, clearing the tape. So one of the things about these screens is sometimes if you're looking for something to happen in a particular direction, a lot of the existing data kind of makes it a bit difficult to read. Okay, so right now I've got 19,000 sell market orders, 22,000 buy market orders. If I look at the current trade columns, I've got stuff above me and stuff below me. And if I'm coming into a level, what I'll generally do is I'll click this brush icon. Okay, and it will actually clear those current trades. So if you're actually looking at this just from a tape reader's point of view, and you are coming into a level now, so let's say you wanted to go long, you're coming into level to go long, because we've reset that, we had 19,000 against 22,000, these 400 contracts that have traded since we reset would not have altered the ratio on the volume profile with those 40,000 contracts on. So one of the things that we find people do is when they get into an area like this, is you want to reset the tape so that you're kind of looking at it with a fresh pair of eyes and actually seeing what's occurred, what's occurring as you're coming into your level. Okay, so that's what we mean by clearing the tape. Okay, so again, we haven't talked about anything particularly earth-shattering in terms of looking at buyers jumping in. Right now, nobody's jumping in on either side. I mean, what we can see, we've had some sell market orders at 250 and 260. This tape that's showing the large contracts, that actually clears, let me just check, it clears after 180 seconds. So 3 minutes, anything older than 3 minutes does not appear on there. So in the past 3 minutes, we've had some large sell market orders. They've only got one tick to their benefit. We can also see, well, 470 against 230 contracts is really kind of, it's neither here or there, really, in terms of the tape. But we can see as we get into level, reset it. As you get into your level, as you get into your value area low, value area high, reset that, and just keep an eye on these ratios and just see if it actually starts to change from, you know, as we've got sell, as kind of a sell heavy scenario here, see if it changes from a sell heavy scenario to a buy heavy scenario. I mean, we just saw some more large sell orders come in, okay, at 525. So we're down to 525. Right now, you've got really no reason to buy this level right now. Okay, so what we're going to do is we've got two more things to look at. The next thing we're going to look at is something called a level break. Okay, and if you are a tick fiend, okay, this is something that you do on the entry. Okay, because one of the things, if you read the order flow, one of the things you'll find, if you're using order flow for your entry, you're probably not going to be able to get into the market with a limit order. Okay, the only time you're going to get into the market with a limit order is if you see the absorption. Okay, and sometimes the absorption works in a couple of different ways. It can happen where you've got a bid size of like 1,000 contracts, and I get 1, 2, 3,000 contracts trade into that, and they keep refreshing it at like 1,000 or 1,500 contracts. That's something you can join, but you're joining it with 1,000 or 1,500 people in front of you. If there's 1,500 in front of you, you need 1,500 more contracts to trade into that iceberg order. So you want to join a refreshing order with 1,500 in front of you. You're probably not going to get a fill. Some icebergs, there's like 300 contracts, and you'll get 1,000, 2,000, 3,000 trade, but the amount of bids there is kind of refreshed to about 300 contracts. So if you want to join when you see absorption like that, that's actually, you can get filled on a limit order that way. So if you can't get in a limit order, then one of the things I look for is something called a level break. And this is actually a fairly easy skill to acquire. Okay, so if you want to go long, okay, you want to attempt to buy into the offer just before the market ticks up. Okay, so you're waiting for the offer to break before you go long. Okay, now the reason it sounds like a silly thing to do, to say, okay, I'm going to wait for the offer to break, because all you're going to, you're not even gaining a tick. Okay, so if you're saying, right, I'm going to hit into that offer, okay, why don't you just hit into the offer now? Okay, why wait till the offer's about to tick? Because sometimes you will actually miss the offer, and the reason that you wait for the offer to break is sometimes it doesn't break and the market goes down, and then you wait for the offer to break again and it doesn't break and the market goes down, and then you wait for the offer to break again, and you've gone down 3 or 4 ticks before you get to the point where it looks like the offer is starting to weaken. So if a market is bid 300 contracts and offered 1,500 and you want to buy, there's no real reason to buy when you've got 1,500 on the offer. When the offer shrinks down to like 300, 200 is a bit low. When the offer shrinks down to 300, that's when you hit into it. So this isn't just about gaining a tick or being in a break-even trade within seconds. This is actually something you can use to make sure you get a better price, or something you can use to actually stop you getting into a trade when the market's still running against you. So quite often I will be at a point where I'm really convinced that I want to get in, and the price will tick down 2 or 3 ticks, and then I might reconsider the trade. Okay, so just doing this is a money saver. And the thing that will help a lot with you in terms of the jigsaw tools, okay, is the strength meter, and we'll look at it again in a second and what level break is. But the other thing is, this is something you should absolutely, well, certainly something you should absolutely consider when you stop out. Okay, so if you're in a long trade and you've got a stop 2 points below, which is pretty common, if it actually moves down 2 points and you're saying, okay, let's say I got in at 1802, market comes down to 1800. Okay, well, a regular stop loss order at 1800 will trigger when one contract trades at that level. Okay, so I might have 3,000 contracts bid at 1800, but when one sell market order trades into that, I've got 2,999 contracts bid at that level. Why would I want to stop out? Okay, and the answer is you wouldn't. If you're saying to yourself, 1800 is my absolute line in the sand, why exit at 1800 if there's a whole bunch of people bidding that level? Okay, it doesn't make any sense. Now, I know some of the platforms, I think CQG actually has something called a volume stop, and I believe Ninja actually has something similar. Jigsaw will soon. But basically, the level break is if you're about to go an exit, so, stop out, sell into a bid because your long trade's not working. You shouldn't really sell into that bid until the bid shows signs that it's actually going to break. There's no point selling into the bid. Now that might be, you might say, okay, I'm going to, on an exit, I might wait for the bid to go below 500 contracts. And if I go below 500 contracts, then I'm definitely going to get out at that level. So a level break, it is good for entry because it will save you a lot of ticks on your entries, but it is also good for your exits. So let's just have a look. Restore. Okay. So what would we do? Okay, we kind of need the market to participate a little bit here. Okay, so if we look at the offer now, okay, that was good. If you caught that in time, what we saw was an offer of 37 contracts against a bid of, I wasn't sure what it was, to be honest, but it was in the hundreds. So if the bid's in the hundreds and the offer is shrunk down to the point that it's at 37 contracts, that's more likely to tick up. Okay, let me just change my power meters. Set that to 2. Okay, so if I just center that right now. Okay, if we look, compare the size at the bid and the offer, I've got 500 bid, 102 offered. Okay, I can see I now I've got 300 bid, 156 offered. Just let it play out. Okay, so it ticks up. Let's try that again. Be a bit faster on the ball this time. Okay, so we're up to a new level. So we have to let the bids and the offers kind of settle themselves when you get into new level. Okay, if I look at the strength meter on the right, I've got 600, 700 on the strength meter on the right. That's more indicative that the bidders are adding to the level and the offers are pulling. Okay, so I've got 350 offered. Okay, now 260. I've got about the same amount on the bid or the offer. What I'd be waiting for now is for one of those to break. Okay, we didn't see it, it was too fast. It's very often the case. Okay, so again, 300 bid, 300 offered. Let's just see if we can see one of them break before the other. Now somebody's just hitting in the whole amount. Okay, now obviously we're using this at predefined levels, of course. Okay, so let's just see. We got 900 bid below. Okay, so let's just see what happens when we get this 525. Okay, because we've actually got some bids there. So I've got 800 bid at 525. Let's see if we can get down there again. Okay, you can see if you just look at if you're looking at 550 there, you can see how the bids went down, but they keep adding to the bids. There's an iceberg order there at 550. So we've got 570, 580 bid. Let's see if they add it back up, if they're going to put some more on there. Okay, so they've taken it back up to 500. Okay, look on the other side. I've got 100 contracts, 200 left. The actual trades at each side is about the same. Look at 550 again. If 550 is going to hold, they need to add back on again. Okay, they're going to add back on. What they were doing at 550, they were adding up to 400, 500 every time that the seller sold into it. Now it's down to 188. I've got 400 bid, 500 bid, less offered. Okay, and it cracked down. So basically, it's not like you're going to have a definite answer on every tick. But if you get used to watching the bids and the offers, just the bids and the inside bid, inside offer, and the contracts trading, you can actually get a feel for which side is gonna crap out first, basically. And that's something called a level break. It's not a very, very difficult thing to do. If you sit there for 10 minutes and start doing that, you're probably going to find fairly quickly you can do like 60 or 70% of the times that you actually make a guess. You'll find like 10-20% of the time it's not clear. 50-60% of the time, fairly quickly, you'll be able to guess whether it's going to tick up or down the next tick. If you're doing this on entry, it's not really about the fact that you're trying to get the offer before it ticks up. What you're trying to do is you're trying to not buy it while it's still got downside momentum. Yeah, it's called this next, which ticks next, okay? So I want to say that again. It's not really about buying the offer before it ticks up, okay? It's really about not buying the offer when there's downward momentum. It's really about bid's going to break, I'm not buying. You know, you're watching it, I know that bid's going to break, I'm not going to get in. Okay, the next bid's going to break, I'm not going to get in. The next bid's going to break, I'm not going to get in. You're doing that when you're trying to go long. Okay, so if those bids below you look like they're going to break, there's really no reason. There's really no reason to hit into the offer or to put in a market order. Okay, so you know right now 930 bid, 220 offered. They're stacking the bids. I mean, if you look at the strength meter on the left, it's quite high. Let's see what happens. You know, we got 960 bid. We've now got 420. Okay, it's going down to the 300s. Okay, they're starting to hit into it. 1806. So right now they're starting to hit into it, but again, now the offers are stacked up to 800. Okay, so it looked then like the offers were gonna go as it went down to the hundreds, but then they put the number back up. They added more offers. Bids been down to 200, now up to 400, kind of middle of the road. The strength meter on the right has gone down. So you know, I don't want to bore you with doing this, but basically this is the kind of thing. It's just a little trick, a little knack that you can actually use to kind of refine things. Okay. Does it give you a bias? Okay, Angela, I take my bias. I'm a big one for bias. For me, if the market's going long, I'm biased short. If I'm biased short, I want the market to come up and not really show me any signs of momentum upwards, price move upwards, but not the order flow really with that price move. So if I'm biased short and I see a move up without the order flow supporting it, then I will fade that. Okay. Yeah, I mean, Murphy, what's going on now? It's just a slow, really crappy day, right? It's a pre-holiday. I'm not sure I'd call it a battleground. It's more like the grandmas and the knitting needles. It's not. I don't see this as some big hairy-chested guys, you know, battling out with swords. It's just kind of like, it's more like a school kids playground. Anyway, let's go and just talk about the next part. Okay, which is staying in the trade, because you know everybody thinks, you know, when we think about order flow, the first thing we think about is refining or rejecting a trade. But actually, for me, the thing it gives me, I kind of enter a trade with a scalper's mentality. I enter a trade with the mentality that I want to get a first scale off at 4 ticks pretty quickly. So everything I do is really geared around, I want to see it move my way fairly quickly after I get in. It is different from what JP does. JP is slightly different. He scales in. So I do something different from JP. Okay. So a part of what I do, I don't just enter the market and say, oh, here's my stop and here's my target, and I'm going to get to one of them first. What I like to see, especially in a market like the ES that does give you second chances, I like to see signs that the order flow is on my side. Even maybe if price isn't really quite getting there yet, maybe price isn't really moving my way yet, but the order flow is on my side, then I'm kind of happy. Or if the price is moving against me, but it looks kind of weak, I'm kind of happy about that. I'm kind of happy because you can't nail everything to the tick. Certainly, if you're taking the kind of major reversals that JP does, you can't expect to take the trade to the tick. For me, the way I trade is I actually let the market reverse first, and then I look for a backstop after that reversal. So I will not get as many ticks out of a trade as JP, because I say, okay, there's a value area low. That's where I think it's going to reverse. Yep, it bounced off the value area low. Yep, there was a lot of participation. Yeah, I think that's a reversal. Okay, I'm going to wait for it comes back now, and I'm looking for a backstop on the way back. I just do that because
block
I
buy.
prefer to enter in areas where there's less people, and I prefer to take less risk, but also move, also trade for smaller targets. So that's just a personal thing. So staying in a trade is basically about price movement against order flow. Okay, so if price moves against you with low participation, there is really no reason to get out of the trade. Okay, you want to see, and by low participation, I really mean not many trades against you, or kind of even on both sides. So if you kind of see the price move down, you print 700 at the bid, moves down, 600 at the bid, moves down, 500 at the bid, moves down. That's a lot of trading against you. If you see like 100 at the bid, move down, and then like maybe 150 at the bid and move down, you're not actually seeing a lot of trading. You could say that it's not taking many contracts to tick down, but basically you're not seeing a lot of guys trading against you. And obviously the other thing is the ratio. Okay, so you don't want to see the ratio heavily. If you're going long, you don't want to see the ratio heavily in favor of the offer side if you've just taken a long trade. Okay, so that's again a consideration. People getting stuck is something you look at. What you never want to see if you're in a long, you don't want to see the large traders come in and get stuck, or a lot of trades hitting into a level and get stuck. And in terms of context, I don't mind seeing that. If I've got my first one or two scales, I'm not really interested in watching the order flow anymore. Okay, so I'm only really watching the order flow. When I say staying in the trade, I'm really only interested in doing this for the first 8 ticks. Once you got past 8 ticks, I just let it run. Okay, once if I can get my first target and my second target, then that's order flow has done its job. Okay. If it gets stuck at a price and just can't push any higher after multiple attempts, well, that's a fade. The other side's going to smell blood. If that's happening against you, that's not a good thing. But if the price, if the price moves against you and it goes down 2 ticks and it keeps coming back, going down 2 ticks, and nobody wants to trade into that price below, you stay in the trade. Okay, so we're looking at the same things, but probably from a different perspective. Whereas the things we talked about earlier, we're looking for the signs of reversal. We're probably thinking about looking for reversal to enter, but you've also got to think about those signs being on your side after you've entered. Now, in terms of the depth, we haven't talked about the bids and the offers yet, because mostly the bids and the offers don't help that much. Okay, but where they do help, certainly after you've entered a trade, is if you're long and the market's moving up, it's good to have a few decent side bids following you up. Now, by decent size, I mean if your average bid is like 1,500 contracts, it's good to have a couple of 1,800, 1,900, 2,000 even following you up. One or two, and it won't be at the inside bid. It'll be one or two levels out. Okay, so it'll be like level 2 or 3. If you see that, like an 1800 just following you up, that's a good confirmation. When that below you turns into like 3,000 contracts at 3 levels below you, okay, that's a very bad sign. Okay, so if you see 3 levels below you, 3,000 contracts each, on a normal day where you average up to 1,500, that is massive spoofing, and that means they're probably about to pull the rug on the market. Now, conversely, if you see that above you, those massive bids above you, that's actually a good sign. If you see 9,000 contracts stacked above you, fine, fine, 3 levels, fine, bring it on. It's not real. There's no reason for them to show that. Okay. Now, as you come into a high, the offers above, the offers above will always be thick. So you kind of have to ignore. I'd normally say if you have good offers above, you have to be a bit wary. But when you come into a high, the offers should be largely ignored, and when you come into a low, the bids should be largely ignored, because it's just a feature of the market that the bids and offers will be thick when you go into the lows and highs. Now, one of the other things, you guys are trading levels, okay? One way to know that you've got a valid level above you is that the offers will be high above it, okay? So if you're looking at a level, if you're looking at a moving average crossover, for instance, and you suspect that the moving average is going to cross over 4 ticks above, the chances of there being thick offers stacked just above where that moving average is going to cross over are pretty slim, okay? If you're coming up to a value area high, okay, and you see a lot of thick offers above that value area high, it means there's plenty of people paying attention to that value area high. Doesn't mean it will stop, yeah, but it does mean you've actually got a significant level. It does mean your level is valid. But basically, for the depth, before I get into the market, yeah, sure, if I'm looking at a long trade and there's absorption on the bid, and I can see 3,000, 3,000, 3,000, 3,000 offered above me, to me that's more fuel onto my fire for the upside. But other than that, I don't really personally use the bids and offers on the ES a lot. I don't really find a lot of use. Okay, so good bids following you up. When they become massive bids, you're basically going to look at least a short-term reversal. Staying in the trade, large traders you want to see on your side. If there's large traders that are not on your side, you want to see them getting stopped out. You also want to see the clusters that you see build on your footprint or on your volume profile. If the market's moving up, you want to see the volume clusters below you holding. Okay, so if it prints up 3,000 contracts each level, and then you print 15,000 contracts at a level, and it moves up, you want to see that level where the 15,000 contracts traded. You want to see that level hold. Okay, and like I say, how long do you keep watching the order flow closely after you've got in? For me, 1 or 2 scales. Once it's moved away from your price, for me, there's no benefit to watching the order flow once you've moved a certain distance away from your price. As a position day trader, I think it's better to let the market run than try and keep focusing on it, because you can get to the point where you jump on shadows. Okay, now let me just go back. Sorry. Right. Good grief. I'm a nightmare at this Windows feature to restore all windows. There you go. Okay. So I just want to show you something that I use to get to kind of stay in a trade. We actually have, with the tool, we do a kind of an auto reset. So what I'm going to do, I'm not going to try and analyze this market, but I'm going to say probably if this is a trading range, it's not going to get below 550, 525. So let's just put a long trade in. It's only a sim trade, with a view to saying, okay, oh, that's a short trade. That's great. I don't even know the difference between a long and a short. Okay, with a view to saying this is going to bounce up. Okay, so what we do, this is kind of an automated feature. When you put a trade in with Jigsaw, you'll see what happened is I've got the NQ off on the side because I like to watch correlated markets. I like to have one market, other market on my side. So what happens when you place a trade here? It recenters both of the domes, it clears out the current trades, and it resets the meter. So that's kind of it is an optional thing, but if you're looking to stay in a trade, it kind of helps to have this stuff cleared down. So what we're looking at for both the NQ and the ES is just the trading activity that's occurred since I entered the market, right? So if we're looking at staying in a trade now, if you look at the trade location, it's a pretty crappy trade location because, we've got this trading range, all this volume on the profile here, 0550 to 625, potentially to 675 where we've got the volume. We just bought the top of it. Okay, so in terms of trade location, it's not a good trade location. In terms of order flow, well, right, so far, 1,500 buy market orders, 760 sell market orders. So although the price kind of went against us, you're not really seeing any order flow against you. On the large trade side, there's nothing really significant there. Let's just reset that. On the all trade side, again, we're seeing some sell market orders, but nothing significant. Look over on the NQ. NQ really hasn't gone up or down, and again, the trades on the NQ are about level. So right now, from an order flow perspective, if you're in this trade, although it's a crappy location, right now the order flow is still on our side. Trade could go against us, right? But right now order flow is still on our side. We still haven't seen sellers jump in. So right now order flow is on our side. If we look underneath us, I've got this 1,600 contracts bid at 575. Now that's highlighted because there's a feature in there that says, you highlight over a certain amount. That's 1,600 we've ticked down. 300 roughly contracts have pulled. And now we've got a large bid at 550. That's not really what you want to see. So we had that large bid at 575. He actually moved down to 550. So he is trying to support the market with his bid, but he's not willing to keep his bid inside. Okay? So that's kind of a negative thing to see. So I've got I've got bids. Let's see how much trade. So far 26 is traded, 30 is traded. We had 1,600 contracts there, 30 is traded. Obviously we can see 580 have pulled. Okay? And the same thing, you see the 1,700 that was there. Look at the order flow now. So I've got 2,500 contracts traded against us. So again, in terms of staying in a trade, I've got a stop loss, potentially a stop loss there. You'd have to say it's not looking good, although, if you look overall, this probably isn't a good place to stop at anyway, because you've got potentially the lower range right here. Okay. It's basically the reason. It's a good feature, and it's just because I was doing it manually for a long time, and I didn't. It took me a while to think. Well, that should be automated. So that brings us pretty much to the end of the presentation. That's basically the nuts and bolts of what I do. So have we got any questions at this point? Yeah, delta weaker on upticks. Yes, there is actually already an alert for that, Paul. It's called a delta divergence. So Paul, as I understand it, and you can tell me if I'm wrong, is what we do is, let's say you have 500 print at the bid and 1,000 print at the offer. Your expectation would be for a tick up. If that actually ticks down, then we give the audio alert. Does that actually do what you're talking about? Well, you're just talking about oh no, sorry, I'll let you talk, Paul. Or type, rather. I'll just bring up MJ. I'll just show you that, MJ. Okay, let me just bring a slightly different tool up. Okay, so when we look at alerts, we're actually looking at this tool here. And we have some alerts here. One is for divergence. So this is where we can actually have an alert. So let's put 300. And then basically, as long as the amount traded is 300, if I see the market tick up, yeah, I mean, it's the same thing. Basically, if the market upticks but the delta down ticks, we'll give an alert, basically. Possibly a different thing. We have an alert for iceberg orders, which I'm sure you've probably heard JP talk about, and we have an alert for a particular large quantity, which is effectively the same thing as absorption. So if I have a large quantity alert,
Bid volume
5,000, then when 5,000 contracts trade at a level, it'll give an alert. So basically, that really shouldn't say large quantity alert. It should really say absorption alert. Can JP pipe in? JP, can you pipe in? I think I sent JP to sleep, to be honest. Yeah, so are there any other questions?
bid volume. Bid volume.
Okay, JP's trying to log on again. Any other questions? OCO orders, they're at the broker. Oh, sorry. The actual orders themselves are at the broker, but the cancellation is local. Now, let me just show you one other thing we do, because I know there's a lot of people that use NinjaTrader, but they don't have for some reason, various versions of NinjaTrader have different features. So some versions you can trade on, but there's no OCO. So if we just look at this trading, close outstanding orders when position is closed. Okay, so if I just cancel that, that is set. It's just cancel the orders. What I can do, instead of using an OCO, we have this feature that says just cancel everything if you close the trade. Okay, so let's just put an order there, and then let's just put an order here. So if I put an order here, okay, right. So when I put that order in below, it got filled, and when it got filled, it cancelled any other orders. So basically, what it'll do, if you go from having a position on to being flat, it will cancel every position for that instrument. So that's a kind of a solution, an OCO solution for people that don't have OCO. In terms of multi-charts, we do plan to, we will be supporting multi-charts. I can't really tell, I would love to tell you what the plan is, but kind of, I don't want to, I can't really tell you, my partner will kill me. But yeah, your multi-charts users will be able to use this. In terms of lots of people being able to see icebergs, icebergs, I don't know if people will spoof with icebergs. I mean, when you're putting an iceberg, you're actually buying. So you're actually buying. Now, there are wash trade rules against buying and selling from yourself. So, I mean, it's possible that people are using icebergs to spoof, but they would actually be buying when they want to sell. Because if you spoof the bid, it means you want to sell. And I've heard of people like buying the market up because they want to get other people to sell, but I'm not sure that somebody would hold the market with an iceberg for a while because they want the market to go down. It seems like an expensive way to do it. Best way to learn it, most of the stuff's on the website. But basically, the best way to learn order flow is basically you need to do, let me show you what you need to do. See if I can minimize. Okay. You need to do this. You need to, okay, basically, if you're going to learn this, one of the things you have to remember is that it's a new skill, a bit like riding a bicycle, right? So you're not going to enter a bicycle race before you know how to ride a bicycle. So before you use this stuff to trade, you need to learn how to ride the bicycle. And the riding the bicycle is actually being able to read and just read the information, absorb it. So what I tell people is your screen should look like this. It should look like one depth and sales and nothing else, no charts, nothing. Nothing else that can possibly influence your opinion of the market. And you spend 60 to 90 minutes looking at this, focusing pretty much on the center two columns, the current trades, and nothing else. And you spend 60 to 90 minutes doing that and no longer, and you do that once or twice a day, and you turn everything off and you don't sim trade, you just do that as a drill, because you're going to see certain things happen. You're going to see the things that we talked about today. You're going to see it go down to a price and a lot of volume print. You're going to see it go down to a price and nothing trade. You're going to see it keep going back to a price, but not being able to go through it. It keeps going back and keeps going back, keeps going back, and then just they whack it in the other direction. So that's how you learn this. The best way to learn it, turn everything else off, just focus on the trades going through, on those center two columns, on the depth and sales, and just spend 5 or 6 sessions, 60 to 90 minutes. And if you do that, send me a Skype message and we'll have a chat about what you saw. Because that's basically the biggest hurdle that most people have with this is they try to use it. They take a trial of this, they open the screens, they put like 50 different depth and sales or loads of different tapes, and they actually try to use it to help their trading from day one. So you've got to learn to use it on its, you've got to learn to be able to read it on its own, and then, you know, once you've got a bit of confidence in what to look for, then you start bringing it back into your trading. So I'm not suggesting you trade on it on its own. I'm just saying you should learn to read it on its own before you try and use it next to something else. Like I say, MJ, most of the stuff's on my website for free in terms of how to use it. Breakout trades. Okay, I will, because I do kind of what I like to see for breakouts, right? On the ES. The way the ES looks right now on here is very typical, where you know, if we discount the fact we already know that this is a low range day, what you will see quite often is a move up, and then you will see this range on the profile. Okay, so when I look at a breakout trade, I'm looking at a range on the volume profile. So when I see a range on the volume profile, I kind of expect it to rotate around that range. And pretty much when it does that, my expectation is right now that the market will go up, purely because it's gone up from 0225. It's built a range up here. It's price acceptance at higher prices. I expect it to break out at the top. Now, I would not buy the breakout itself. I would actually buy this level, 550, and I would try and scale 650, because I always scale at 4 ticks, and then I would try and hold on to it for a run at the top. So in terms of a breakout trade, what you are looking for basically is you're looking for momentum and size into the level that's going to break out. Okay, but for me, I only look at breakouts when the market's built a range like this, and I'm generally looking to buy at the bottom of the range. So it doesn't really help, I know, but basically, for me, wait for the volume profile to build, buy the bottom, scale some out, and then hold the rest for the breakout. So probably not the kind of breakout trading you're talking about, but I don't breakout trade any other way. Now, can you manually reset the volume profile at any time? In terms of like, all the profiles can be reset except the volume profile, and what you can do is the volume profile will follow the session times set in the platform. So with Ninja, you can set up specific specific session times. So I have kind of a split session where my session starts at 9:30 in the morning, and then it ends at 4:15, and then I have another session that I set to start at 4:30. So basically, you can't set it just like any time, but you can set up session times. Yeah, different session times. Yeah. Oh, yeah. Well, I actually have a session. I have a session. Let me just, I can show you. Probably easy to explain, to show you than explain it. Okay. I look. This is bring over the Ninja Session Manager. Okay. Right. Okay, so this is my session time. So with this set, my volume profile will reset at 4:30 in the evening and 9:30 in the morning. Okay, so you can't reset it halfway through the day, but you can reset the split profiles, but the volume profile will just stay for the session. But yeah, I agree. It'd be good to have like kind of visual profiles in all the columns, but what we're trying to do, Zukal, we're trying to keep it performant. So we don't. The more profiles we add to these columns, the more chance we have of actually slowing it down at peak times, and that's already a bit of a problem with Jigsaw, slowing down at peak times. Yeah, it's only showing MJ right now. It's only showing the volume for that session on the volume profile. JP, a question for you there. Decreasing delta on upticks. I'll just explain what we do, JP. What we do is if price ticks up but delta ticks down, we have an alert for that. And I know you look at weakening delta on upticks. Is that the same kind of thing? Price ticking up but delta ticking down? Thanks for that long, lengthy, and detailed explanation, JP. That's fantastic. Yes. Any other questions? Yeah, it'll work with multi-charts in the future. I can't tell you the exact plans, but yes, every platform will be supported effectively. Okay, any other questions?
Hello, hello.
Here he is. JP, the floor is yours. I think we're done on the questions.
Okay. Yeah, see, I see in the footprint, in the actual footprint bar, I can see the price tick up and the delta ticks down.
Yeah.
Now, Robert Hoffman, who turns this thing apart inside outside, I mean, he's totally delta, aficionado or whatever you want to call it. He said his theory is that it's a market order coming to the same time and matching them. So, I mean, I don't know what exactly it is, but it definitely sets a red flag off, because most of the time when I see that, we sell off.
Yeah. Yeah.
So you do have an alert for that in there, huh?
Yeah, we kind of let me just bring that back. Oh, did I get rid of it? Yeah, we do have an alert for that. Let me just pull it back up. Okay. Just explain how it works. It's this a divergence alert. There's a minimum quantity basically, but the way it works, JP, is if we get like 1,000 print at the bid and like 500 print at the offer, but it ticks down, then we'll give that alert. Does that make sense? So
yeah, I get it's mine's not set to any. I don't have any exact number on it. It just when I see the delta change and when it just upticked, I'm like, wait a second, something's wrong here. That's a red flag.
Yeah,
when that happens, it tends to sell off.
Yeah, the reason we have and
I mean big time.
Yeah, the reason we have a quantity on there is because it doesn't do an alert if like it ticks up to a price and like it trades 10 on one side and 12 on the other and ticks down. The alert is like the amount of difference. So if the difference between like if you trade 100 at the bid and 100 at one at the offer and it ticks down, it's not really the a significant difference in delta. So the 300 is how much difference do you want between the two. You can put it to 0 if you want.
Okay. All right. I'm gonna try that.
Yeah.
Well, and by the way, really good presentation here, young man. Not bad for a guy who came just straight from the bomb.
Exactly. Well, thank you, sir. Do I use the alerts? I don't use the alerts. I don't use any of the alerts, I'll be honest. And the reason I don't use the alerts is because I'm always watching it. So I can see them happen anyway. And thank you. Well, thanks everybody for staying, and thanks everybody for actually staying through the presentation. It's always wonderful to see when people actually stay in the room. And thank you, JP, for inviting me. And hopefully everybody's going to have a good Thanksgiving. And for those of you who don't celebrate Thanksgiving, just have some good time off trading. So thank you all.
Pete, thanks a lot. I appreciate it.
Yeah,
I really do. You guys, go ahead. I'm sorry.
Yeah, and if anybody wants to email me, my email address is there. I ain't gonna hard sell you on anything, man. If you want to email me or you want to Skype me and have a chat, I'm absolutely fine with that. You know, I like to talk to other traders. Met two guys, a couple of guys from San Francisco this afternoon for lunch. So if any of you are in Bangkok, just give me a call. We'll go for lunch. We'll have a good chat. My Skype name is Jigsaw Trading. All one word.
Yeah, I'm in Bangkok. Let's see, there's a red light district there. There's your house. Where do you think I'm going?
JP, look, JP, we know you've been blacklisted.
I'm joking, everybody. I'm joking.
JP's been blacklisted. He's on the immigration blacklist. He's not getting past the door.
I'm going to get some email from women in here. What? I was joking. You guys, listen, before he leaves, let me just say, and I totally stand behind this software. I really do. I think it's great software. I think it's good. I mean, the dome alone is just better than what you've got that anybody has out there. I mean, you know, he showed you today in this presentation. I've showed you before too that it just has more information, that usable information, not a bunch of crappy bells and whistles stuff that doesn't work. Usable information. Be able to see those polls and the bids and offers of them. That to me is huge. So you might, you know, like I said, I'm not trying to do a sell here, but I mean, I think, in my opinion, you know, this is one of, you know, you need certain tools to trade, and as all the domes I've ever seen, this is by far the best. So I would give it some consideration about you. All right, that's all I can say. I'm not trying to sell you on it, you guys. That wasn't even the idea of him coming in here today. It was just to show another point of view of how, you know, order flow works and his take on it and stuff. But the dome alone, I think, is worth the money. But boom, that's, you know, that's the way I view it. I mean, you guys think about it. I trade off another dome. I trade off a really basic dome, but yet I use his dome for information. So, you know, consider that. I mean, all right, that's all I wanted to say. Trader I see a PM. Hang on a second, bud.
All right, thanks everybody. I'm gonna mute the mic now, so I'm gonna hand back to JP so that he can carry on doing his thing for the rest of the day. So thanks a lot, guys.
All right, thanks, Pete. Again, you guys, I'm switching over. Hang on.